This is Think Tech Hawaii. Community matters here.
And we are back live here in Think Tech Studio, Hawaii. I'm your host, Prince Dykes, coming to you guys live all the way from Honolulu, Hawaii. And guess what, guys? We didn't get canceled. We got another episode, so we're going to enjoy it. But as you guys already see in the description box, today's episode is going to be about interest rates, federal government interest rates. And I know you're probably thinking, man, why is that so important? So to start this thing off, one thing that I was at Berkshire, which is Warren Buffett's, the greatest investor of our time, annual meeting 2 months ago. And one of the things he said, he was like, hey, if I could have one tool going into the future, this is verbatim, if he could have one tool going into the future, he would like to know what interest rates would be. And I wrote that down and I said, okay, interest rates, that seemed like it might be a little important. But we're going to go through and we're going to talk about what are interest rates, why are they important, future interest rate, how you can invest in this interest rate market, all the other great stuff. But as always, guys, I don't have a lot of time, and I definitely know you guys don't have a lot of time, so we're going to jump straight into it. So with this topic, I brought in a very special guest. We're talking about a 40-year Wall Street veteran that was around in the 70s, the 80s, the 90s, the 2000s, James Foytlin. If you followed me before on the Investor Show, you've seen him before coming in all the way from Wall Street, and I have him on the line today, and I want to go ahead and introduce him. How is it going, James?
Hey, how are you today?
I'm doing outstanding. Thank you for calling in. For people who don't know who you are, tell us a little bit about yourself in this financial industry.
Oh, I guess the important thing to know about me is I had been involved in investing basically since I was a kid in the 70s. Then I worked on Wall Street from about 1982 till 2008, I guess, is the whole time where I was full time.
Okay. So being around the market and stuff like that, right? So you're an expert. You've seen a lot.
Seen
right?
a few ups and downs. I don't know if I call myself an expert, but I've gone through a couple of market cycles.
Okay. Well, that's experience, right? That's a lot of experience that you have. Now, this thing, federal government interest rate, to anybody out there listening, what are the federal government interest rates?
Well, right now, what you have is an unusual situation where you have historically low interest rates, and they've remained historically low for probably, I guess, the better part of 10 years.
Mm-hmm.
It's abnormally low. And for a lot of people, you're just about to see the Federal Reserve is in the process of raising those rates up from those historically low levels.
Okay. Now, the thing I want to piggyback off of what James just said, he's talking about the interest rates are historically low. Now, the federal government interest rates, they are so important because they control all of the interest rate. It goes in a domino effect. The federal government, it has its own rates that the chairman, Jane Yellen, she controls, and she's the one that controls the interest rates that the banks get. And the banks control our credit cards, our houses, our loans, all the good stuff like that. It's a way that they can raise and lower the interest rates, which is one of their most powerful tools. Right now, the interest rates, he said, at a historical low is at 1.16 currently as August 11th. Now, they meet about every year, the Federal Reserves, and they can decide whether to raise interest rates or to lower interest rates. And they raise interest rates in a way to slow down inflation, to cool off the market, to make sure we don't build this big asset bubble. And we got into this low interest rate society big when in 2008 as part of a stimulus package to stimulate the government lowered interest rates, and by lowering the federal government interest rate, it's freed up a lot of money. So businesses will more likely borrow more money because it's cheap. You have a low interest rate, business say, hey, you know what, we can buy this and maybe hire more employees, build more things and stuff like that. So now we've been in a bull market here since around about 2009, which means the market has been going up, up, up. And now we're kind of seeing interest rates kind of curve and cut up a little bit, from going from zero practically, and now they're at 1.16. And James is saying, hey, we've been in this thing for a long time. Now, I know you've probably seen something like this play in the past. How did it affect our economy and the stock market, you would say?
Well, first of all, we need to go and look at what really went on. You mentioned the 2008 financial crisis. The Federal Reserve lowered rates, and then they went into they even try to push rates lower by doing something called quantitative easing, which is a really big word for basically they printed a lot of money and they pushed it into the economy. The idea is just what you said, make money easier so people will spend it. The reality probably is more that the money went into the stock market and made the stock market go up more than people spent it. What you have now is you have two big issues going on with the Fed. The Fed, under normal circumstances, we always say if interest rates go up, stocks go down. If interest rates go up, bond prices go down. But this is a very long telegraphed move by Janet Yellen, the Fed chair. She's been signaling she wants to raise rates for a very long time. She has really two problems here. The first problem is she needs the data to prove that the economy is getting stronger. But the second problem, that's a lingering problem probably since the end of the Greenspan era, which now we're talking probably in the early, I would say, in the 1990s. Greenspan was talking about this. The measurement tools that the Fed has, there's a lot of skepticism about how accurate they are at measuring the economy. So Yellen's been looking for an excuse to raise rates, but she needs to see it in the data. And the data so far has been very mixed, although this morning we had a fairly significant increase in retail sales. So I think that's gonna get her to start to ratchet things up, albeit very slowly.
Okay.
The Fed works best for investors. I think my point is that a lot of the interest rate raises are already they're sort of in the market already. They're already calculated. And because interest rates are at this historically abnormally low level, it's going to take a while for us just to get up to what normal interest rates might be, like the norm, what really interest rates should be. Traditionally, if the Fed were to make rapid movements one way or other, either raising interest rates or lowering interest rates, it would dramatically impact the stock market. But the stock market historically has liked if the Fed got on a program and said, hey, we're going to start raising rates a quarter of a point every 60 days or every 90 days or every if the Fed goes creates a plan and starts to follow through, the market's probably not going to be too bothered at these levels by whatever the Fed's doing. If the Fed suddenly becomes very erratic and sort of waits too long and then has to ratchet interest rates up really quickly, that could create a lot of blowback with the stock market. In other words, you could knock the market down really significantly.
Okay. Now, by you saying this, right, you make some very great points. As he's talking about Janet Yellen, they call her Mother Goose on Wall Street, correct?
Yes, she's the Mother Goose.
So she's Mother Goose on Wall Street, and she has the power. Once they're elected by once they're appointed by the governor, the president.
Right, they're appointed.
And the Senate approves them. They're pretty much, in their own little lane to do whatever they want to do. Now, the thing about it is that he spoke about quantitative easing. People call that pumping money into this market. And, some people say, hey, well, we think it's created a bubble. But the thing about it now, James, is that we're at this historically low interest rates level. Where do you see interest rates going into the future, and what effect do you think it will have on the stock market?
Well, I think if there's because this has been such a long telegraphed process, so in advance, I think you see a lot of that in the market already. The market is reflecting, in my view, much higher interest rates than now. Although much higher interest rates than now would still be very low interest rates.
Okay.
And I think that's what you have to understand is that we're coming up from a really low floor.
Okay.
So we're going to need to raise rates. The Fed's going to need to raise rates really significantly to even get to where it starts to become an issue. Like I think it's sort of under the radar yet. Like rates can go up quite a bit from here, maybe even double from where they are at the Fed level. And that may have very little impact on the stock market. But once you start to push past, say, doubling where they are here, or maybe then it's gonna start to be a measured move, and the market may have some issues digesting like much higher rates.
Okay.
Again, it's all in the follow through. Is if the Fed does this methodically over a long period of time, they keep talking about it. I mean, Yellen's on TV every minute saying, look, we're looking to raise rates. And then sometimes she'll backtrack and go, but I'm not seeing the numbers yet to raise rates, but I feel like we should. Well, now with retail sales going up a lot, there's some other issues that you might think that are implying that the economy is starting to move forward at a much faster pace. I think she's gonna start to follow through now.
Okay.
Again, I'm going to go back to what I first said is you got to still look at the data. And the data has got to really prove out for the Fed chair. The data she looks at has got to say, hey, this economy is growing. Inflation is starting to build. That's what she wants. Then she's going to raise rates to combat that. I think one of the issues is that despite her talk I would say probably in the last year, 2 years almost, of trying to raise rates, the data hasn't followed through. We've had a good quarter, a bad quarter, an okay quarter, a good quarter. It's been very inconsistent. And then, of course, there's a lot of people who argue that the data the Fed uses doesn't really measure the economy correctly. Inflation is much higher than the Fed is measuring it at.
Okay. Well, hold on,
the
James.
Economy is,
Before we go any further, we got to take a quick commercial break, and we're going to come back with
Perfect.
more from James, and we're going to come back with my opinion and stuff like that. So, guys, stay tuned to the Prince of Investing.
This is Think Tech Hawaii, raising public awareness.
But grandmother, what big eyes you have.
She said.
What are you doing?
Research says reading from birth accelerates our baby's brain development.
Push!
Read aloud 15 minutes. Every child, every parent, every day.
Aloha, I'm Richard Concepcion, the host of Hispanic Hawaii. You can watch my show every other Tuesday at 2 p.m. We will bring you entertainment, educational, and also we tell you what is happening right here within our community. Think Tech Hawaii. Aloha.
I just walked by and I said, what's happening, guys? And they told me they were making music.
It's the way you walk, it's the way you talk.
They said I could play, so any chance to play at all. You know, that's my life. I love music.
Yeah, I saw it.
And guys, we're back. Thank you guys for tuning in. If you haven't seen us earlier, we're talking about the federal government interest rates and your investments. Now, we did a lot of talking before the commercial break, talking about, the interest rates, where they at and historically and things like that. Now, I'm joined by my very special guest, But before I jump back into that, I want to give you guys like a simple way of people saying, hey, how interest rates could affect the stock market. Not only the stock market, we're talking about real estate, your credit card, banks, loans, all that type of stuff. That's why it's so important. But one of the things people say, hey, if the government raises interest rates, the stock market's at an all-time high. This morning we had great retail reports. If the federal government gets good indications and data that the market is going up, they have a tool that they can raise particular interest rates. Now, what raising interest rates does is it makes money a